Okay, here we'll be looking at some of the most important aspects of technical analysis, including strategies to enter the market around important technical levels. Although I'll be covering the Forex market, this can be applied to any market. Even if you're not a trader, but perhaps, say, a value investor, you'll gain some insights to improve your market timing, so to optimize your risk to reward. I'll talk about technical analysis, what it is, why it matters, finding the best levels, and then big level entry strategies. So let's start at the start. What is technical analysis? Now, I'm not going to go too depth into these topics. I'm keeping this streamlined and just covering the essentials, the basics you need to know. So consider technical analysis the use of historical prices to predict future prices. And this can be through quantitative tools like the RSI or a MACD indicator, or qualitatively. So price patterns, charting on those patterns. Now, you'll find a lot of controversy about whether technical analysis actually works, but you don't really need to get sucked into those discussions. Just look at a chart for yourself. You can't dispute the fact that there's patterns here. So here we have the US dollar yen. And again, this can be for any asset, any pair, any chart, any time frame. This is the monthly US yen. And you can see right now price is stalled right here. And it's actually had quite a bit of difficulty here. It's touched it a number of times over the past 1, 2, 3, 4, 5 months now. Not able to get by this level. Why is that? It's because it's a significant technical level. We can go back to 2020. Where we were 2000. The year 2000, we can see that this level had been a level of support in this period. Again, a level of support, some resistance, support, resistance, support. So what's happening is we have a technical level that price is responding to. So there's no debate here. Price responds to these levels. You can also see this sort of sloping downward pattern here. Again, that's no accident. You can see there's different trend lines that will also act as resistance. Here we can see one acting as resistance throughout this time period. Then as price breaks it, the former resistance becomes support, and price then uses it to follow it downwards again to this significant price level. So these aren't accidents, they're patterns on the chart that traders use to place trades. And we can also look at a quantitative one, the 200 period moving average here. And again, same situation. We have price coming down and using it as support right here, as support, tagging it precisely as support here and here. And here we actually have it overlapping with that strong technical level concept called Confluence, and we'll talk about Confluence shortly. Now, why does this occur? Well, because behind prices are people, and in some cases algorithms with rules designed by those same people. People have a natural tendency to see patterns, something referred to as pareidolia, and we also have a need for understanding. So these patterns and being able to read a chart, they are comforting. They give us a sense of control. So we get these concerted efforts of similar orders being placed around levels, this herding behavior, which translates to these price patterns, which we can clearly see on all of our charts. So there's opportunities here. Again, even if your trading style is based on fundamentals, positional trading, or if you're an investor looking to buy an index fund, if you incorporate technical analysis, you only strengthen your strategy. Now, not all levels are created equally, and I'll use Arxham's wisdom to quickly illustrate how complex this can be. So there's many types of technical analysis levels. We have the dynamic quantitative ones that change as price changes. So moving averages could be an example. Here we have the 100 and 200 moving averages. And of course, we have traders working on all different time frames, so there's multiple targets even with this. Then, of course, we have trend lines, horizontal support lines, Fibonacci levels, and so on. So how do we know which level to trade? Well, this is where the power of Confluence comes in. Confluence is essentially the clustering of several of these technical levels. So this, of course, influences our probabilities. If you have several important levels in one cluster, then there's just more traders watching those levels. So more orders and more chances of price reacting to that level in particular. And I'll talk about price action around these levels shortly. First, let's have a look at some examples of Confluence, and I'll use Wisdom again to speed things along here. So here we have Wisdom open, which is designed to find these areas of Confluence. This is the pip range for the area, the size of the Confluence level. So here we want to find a 5 pip cluster, the strongest 5 pip cluster. This is the scope. We want 500, so we have 500 pips above price and 500 pips below price. That's the search range. So we're looking for the strongest 5 pip cluster within 1,000 pip range. What we can also do is go down and make the level, the highest level appear. We can change the entire color scheme of the levels per time frame, but for the histogram, we can make the largest, highest, strongest level appear. So clearly we have a lot of levels going on from all different time frames. We're on the 4-hour chart here, so there's levels from every time frame. Now what we can do is turn the histogram on, and we'll see now that this red bar here indicates the highest confluence, and we did a 5 pip range, so the highest 5 pip range with the strongest overlapping levels, including all these levels. And the other levels are also marked here with varying lengths of strength. So we can quickly find these areas of high probability, and we can see from the chart here that this zone is clearly a strong level. Going back throughout time, this level is clearly something that's been respected in the past. So now we found it quickly by using the software. The idea behind Confluence then is overlapping levels. More levels means more traders watching those levels, means more trades being placed in that area, means a higher probability that that area is significant. Okay, so that's Confluence, these big technical levels we want to find. Now what? Let's consider the order flow around these levels to understand the basics of some entry strategies. So hopefully you understand the different types of orders, and if not, here's a real quick crash course. There's essentially 2 types of orders placed immediately or orders that are to take place in the future at a different price. So market orders are orders to buy or sell at the current market price, and then pending orders, and these can obviously be buy or sell orders that are not executed at the current market price, but rather at another price that's set by you, the trader, and is executed when price reaches them. So think of pending orders as liquidity. They're orders on the books that are waiting to be executed, and market orders are eating up that liquidity. So if price is moving, liquidity is being consumed in that direction, and price can obviously run into various pools of liquidity, these clusters of pending orders. And if liquidity is low, there are a few pending orders, price can move with a lot of momentum, sometimes in a very volatile manner. And if large pockets of pending orders are hit, then this could halt or even reverse price. Then finally, we just want to consider what stops and take profits are. And these are essentially pending orders that are just the opposite of your trade, right? They need to close your trade. So if you're in a buy order, your stop would be a sell order, and your take profit would be also a pending sell order. Okay, so how do these orders typically cluster around levels? Let's consider this area here. It's been pretty significant, and odds are we'll get some predictable price action around the level. Others will be watching it and placing their trades accordingly. Now, first we need to consider the approach. We have this trend approaching. Buyers have been in control, eating up all the sell orders and pushing price higher. So let's consider these buyers. First, their stops have been accumulating during this trend. Again, if they're buyers, their stops will be pending sell orders. So all along this trend, we have a number of pending sell orders accumulating. So that's number one. Number two, this level we're looking at, it's obvious. Everyone can see it and they're aware of it. And many traders might use this level for taking profits. There's a chance that price could reverse here and they want to pull out some profits. So they place sell pending orders, their take profits at this level. So we've got their stops, the sell orders accumulating below, and we have their take profits accumulating above. But of course, we need to consider others as well. The market's full of people trading different strategies, different holding periods, different agendas. And some of these people will be counter trend trading. They'll be looking for a reverse or a bounce off this level. And these levels offer some incredible risk to reward ratios because price can turn on a dime here. So they place pending sell orders right at the level. And they'd likely put their stops on the other side, protected. And if price breaks, they get stopped out for a low risk entry. So because they're selling at the level, their stops are pending buy orders. So we've got orders building up here from both the long trend traders and those looking for a reversal. We have a pool of sell orders right at the level, essentially creating a self-fulfilling prophecy, right? This sell liquidity is a barrier. It can influence price, which we all see reflected in the price action on our charts. Now, finally, breakout traders. If the sentiment is strong, this level won't hold, the liquidity will be eaten up, and the level can break. If it does, it's pretty significant psychologically. Our anchor, our price anchor, shifts up, and then price can rapidly break away from the level. And we've already got a pool of buy orders clustering above here from the reversal traders, their stops. But there will likely also be some pending buy orders from the breakout traders waiting to be triggered. And of course, those waiting to get in at market once price breaks the level as well. So essentially, order flow is skewed for a quick breakout from the level here. Okay, so there's some typical clustering of orders around these levels. You have the people approaching, taking profits at the level, stops below them. You have people looking to jump in on the price action, anticipating the movement here, so placing more sell orders right at the level, then buys accumulating above. The reversal trader stops, as well as breakout traders looking to enter and get long. We get this steady march upward with stops accumulating below. Then a decision needs to be made at this technical barrier. And the closer to the level, typically liquidity dries up a bit. Prices approaching this decision point, it will either go higher or not. So new buyers on this uptrend are likely not jumping in. They're aware of the uncertainty above. Also, those looking to get the reverse or bounce, the better risk to reward for them is to sell as close to this level as possible. They'd rather not be entering a sell order down here. The risk to reward isn't as good. So right before the level, you often get liquidity drying up a bit, and this can create some spiking volatile price movement. So watch for that. If you're looking for a short-term strategy, this might be something to look into. Getting long as price is stalling just before a level, then ride the spike into the pool of liquidity above. Think of these big pools of liquidity as a magnet, so go long into the pool. And you can try the reverse strategies as well, setting orders right at the level. You might set a quick take profit to just scalp the bounce off these levels. Or if you're looking to build a position or find a low risk entry, you can move your stop to break even quickly, then hope you get one that sticks. So these are incredible opportunities to build longer term positions, as well as offering short term scalping opportunities as well. And finally, consider these stops here that have been building with the trend traders. What can happen is a stop cascade where this buildup in orders, sells in this case, trigger, and like a series of dominoes can cause price to rapidly fall. And when this happens, whatever you do, you don't want to be chasing price. Don't think you've missed the boat and try to jump in to catch these moves. This will almost always end poorly because you know it's likely an artifact of the orders which have been built up. Instead, you might look to fade these. So you look for massive counter-trend spikes and use those to enter. Okay, so that's a basic overview of technical analysis, why you want to use Confluence for these levels to increase your probabilities, how orders cluster, which create many of the common trading strategies that people rely on to enter the market. Hopefully, understanding the dynamics will help inform your own strategies, whether it's a short-term scalping strategy, getting the bounce, using the pools as magnets, fading cascades, the breakout, or if you're using these as strategic entry points for, say, position trading. If you're following the positioning of commitment of traders data, for example, fundamental trading, sentimental trading, or whatever approach you're using, always work in the technicals.